Hello and hi Dr. Tan Yang Ling. Today our group will present about assignment 1. The topic that I have been given is structures of financial market. Before that, my name is Muhammad Hazid Daniel and my group members are Ali Farhan, Imran Fidaus, Nur Shahira and Nur Alia Masara. So, as we know, structures of financial market has 4 categories. First is money and capital markets. Second is primary and secondary market. Third is a debt and equity market. And lastly is exchange and over the counter. So I will tell generally about financial market. Financial market is where financial securities like stocks and bonds and commodities like valuable metals are exchanged at efficient market prices. Efficient market prices means the unbiased price that reflect belief and collective speculation of all investors about the future prospect. Also, the trading of stocks and bonds in the financial market can take directly between sellers and buyers or by medium of stock exchange. And lastly is a financial market can be domestic or international. So I will give an example about money market and the detail will be explained by Imran Firdaus. So, what is example of money market? So, government bonds and corporate bonds that have a maturity date a year or less are paid back in a year or less will be traded, bought and sold in the money market. And the interbank lending that's taking place. So, commercial banks are lending to another commercial banks or commercial banks are borrowing from another commercial banks. Those are often daily and therefore take place in the money market. So any asset with the payback date a year will take place in money market.
Hello, Assalamualaikum warahmatullahi wabarakatuh. My name is Imran Fidas bin Kamarudin. I am from class JBA 2512A and today I will share with you about money and capital market, which is from chapter 2. Money is a financial market in which only short-term debt instrument, those with original maturity of less than 1 year, are traded. Second one is capital market. Capital market is a market in which longer term debt, those with original maturity of more than 1 year, and equity instruments are traded. Next, money market securities are more widely traded than long-term securities and so tend to be more liquid. Short-term securities have smaller fluctuations in prices than long-term securities, making them safer investments. Money market instruments are high liquidity and relatively low default risk. And last one, capital market instruments often carry greater default and market risk, frequently return a relatively high yield. What is the impact of the COVID-19 outbreak on capital markets? The initial impact of the COVID-19 outbreak on international and domestic capital market has been acute, with sharp price adjustment observed across fixed income and equity markets. The outbreak to date has resulted in the following developments. First one is global financial market volatility and repricing. Second one is liquidity crunch across global financial markets. The third one is capital outflows and currency depreciation versus the US dollar, which is USD. And the last one is low or no activity in some bond markets. That's all from me. Thank you.
Hello, Assalamualaikum warahmatullahi wabarakatuh. My name is Ali Farhan and I will continue to present about primary and secondary market. First is primary market. Primary market is a financial market for new issues or security such as a bond and a stock. They are sold to initial buyer by the corporation or government agency. Okay, next is secondary market. Secondary market is financial market in which securities have been previously issued can be resold. Okay, they are divided by two. is broker and dealer. For broker, it's a agent of investor who match buyer with seller of securities. And for dealer, it link buyer and sellers by buying and selling securities at state price. Okay, now I will relate with current issue, that is COVID-19. So COVID-19 affect the global bond trading market. From March to May 2020, the COVID-19 pandemic caused extreme uncertainty in financial markets. So investor therefore shift from risky to safer investment. So there was a particularly strong demand for government bonds with a good credit rating, which currently still show negative yields. Okay, corporate bonds and emerging market bonds experience massive distortion in the wake of the COVID-19 crisis is in 2020 spring. So central bank were able to stabilize the situation with their intervention. So next is, how has the pandemic affect market liquidity and bond spreads? Okay, in the extreme market environment in 2020 spring, the spread of corporate bonds weakened significantly. So the situation has since come down. Okay, however, liquidity in the market for many bonds is still low and below the level before the COVID-19 crisis. That's all from me.
So next, I will be explaining about the equity and debt market. So what is equity and debt market? So a firm of individual can obtain funds in two ways. Firstly is by issuing a debt instrument, which is mortgage or bonds, and secondly is by issuing equities, which is common stocks. So to explain detail about the debt instrument is a contractual agreement by the borrower to pay the holder of the instrument fixed dollar amount until a specified date, which is the maturity date. So a debt instrument is a short term if its maturity is less than 1 year. Next is by issuing equities, which is common stocks, claims to share in the net income and the assets of a business. So usually make periodic payment dividends to their holders and considered long-term securities because they have no maturity date. So moving on to the next slide is the equity prices of major benchmarks and selected implied volatility indices during the pandemic of COVID-19. So based on the graph, the equity prices started to decline badly on early March due to China's lockdown affecting investors' sentiments. And the other graph shows the volatility of the equity market. So the economic impact of the global spread of COVID-19 has heightened market risk aversion in ways not seen since the global financial crisis. So stock markets have declined over 30%, and implied volatilities of equities and oil have spiked to crisis levels, and credit spreads on non-investment grade debt have widened sharply as investors reduce risk. So next slide shows the rise and fall of spreads on investment grade and high yield corporate bonds during the pandemic. So based on the graph, you can see that it declined during March 23rd because that was when the COVID-19 started, and that is when the market volatility are at its highest. So the investment grade corporate bond market, which functioned well in the global financial crisis, did not in the COVID-19 crisis and required aggressive emergency intervention by the Federal Reserve. So the COVID-19 crisis triggered sharp falls in the prices of investment grade corporate bonds, proportionately more than for high yield bonds, which was surprising as high yield bonds are riskier, less liquid, and more sensitive to a deterioration in the economic outlook.
Hi, I'm Nusara binti Morafli, and I'm the next presenter for the exchange and over-the-counter. I will start with exchange first, where buyer and sellers of securities of their agents or brokers meet in one central location to conduct trades by meet them face-to-face. A stock exchange has the benefit of facilitating liquidity, providing transparency, and maintaining current market price, such as Bursa Malaysia. Meanwhile, over-the-counter market or off-exchange trading is done directly between two parties, without the supervision of an exchange. It is contrasted with exchange trading, which occurs via exchanges. As we all know, the secondary market is basically the stock market and refers to the New York Stock Exchange, the Nasdaq, and other exchanges worldwide. I have provided the exchange rates graph selected emerging market economies based on January and May of 2020. The COVID-19 crisis and steep oil price declines have led to sharp swings in foreign exchange markets. As we all know, since COVID-19 happened, there is plummeting oil prices of exchange rates of key emerging market economies dropped substantially, notably those of the Brazilian real, Mexican pesos, Russian ruble, South African rand, and later the Indonesian rupiah, as well as Turkish lira. The second feature is exchange rates of selected advanced economies based on January till May of 2020. The currency depreciation accelerated between end of February and end of March 2020. The currencies of advanced economies have generally strengthened over the period, particularly the US dollar, Japanese yen, euro, and Swiss franc in figure 2. After a notable drop in the first half of March, the Canadian and Australian dollar rebounded.